Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's December 4th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Hope all of you enjoyed Thanksgiving, the family. Spent it with my sister who came down from New York. We ate together with families, which is really cool. And then afterwards, we took a nice plate to my mom, who's in the hospital still, who is finally being transferred out of ICU and into a rehab facility, which she'll probably have to stay there for about 2-3 weeks because she's been in bed for 2 months. Things are going much, much better, but, just going to start walking and building up her muscles again and making sure she's okay to take care of herself at the house. So I just want to say thank you for all the prayers. I want to give you guys a quick update on that. And Thanksgiving, it's just such a cool holiday. I mean, I love football, all the food and everything. But I can tell you, you're always happy when it's finally over, right? I mean, there's nobody that travels to, say, your family member's house on Thanksgiving, and, after they're done, they're like, hey, you know what? You mind if we stay a little bit longer? I mean, no way. That never ever happens. It's like, hey, we're here, everything's good. And then as it winds down, it's like everyone's looking at their watches going, okay, we're done. I mean, even for the families that host Thanksgiving, and once that last person leaves, it's like, whoa, thank God. Now things get back to normal. And I don't say that in a bad way. It just gets really hectic. And it's always great to see family, but there's usually a set time before you tell everyone to get the F out of my house. For some, it's right after dessert. For others, it's after the 4:00 football game. But everybody has a set time. This does get a little crazy, but I still love it. I love hanging with family. I love everything about it. The food, the being thankful for everything, the football. I just, again, it's my favorite holiday. It's really cool. So hopefully all you guys had a fantastic holiday. And once again, I want to say thanks for all the prayers for my mom, who is doing a lot better. Now, let's get to the markets, right? December. And open up this week with a few down days. Wasn't too big, right? And the financial media goes nuts. They go nuts. I mean, I'm always looking at it to gauge sentiment, to see what's going on, what are they saying, because that's what everybody watches. I like to watch CNBC, Fox Business, whatever it is. Read the Wall Street Journal. They started going nuts. I mean, I don't blame them, since there's almost nothing to talk about now that earnings season is over. So is Black Friday. There's really nothing going on. So they're pounding. And I mean pounding you with stories about the trade war again. It's on, it's not on. You hear from a reporter in China, well, China thought there was a deal. And Trump's like, no, there's no deal yet. Oh, wait, things are great today. I mean, this is 24 hours I'm talking about. China said, we thought everything was okay. Then they said Trump walked away. He was not okay. And then today in the morning, which is Wednesday, he basically said, no, I think talks are great. Talks are awesome. And it's just so funny where these sources come from. So now we have the trade war on again, right? And that hurt stocks for a little bit. I mean, we're up a little bit Wednesday. But it's funny when you have a couple of down days, you have the analysts comparing this December to last December. Guys, I don't know. It wasn't that long ago when we've come back and at near all-time highs. But the sell-off last year was incredible. I mean, it went down a ton heading into December, and then towards the holidays, where there was very little trading, and that was all out. I have no idea. It was just, it was amazing how hard the market fell the last few weeks of the year. Crash, and people now think, well, it's December, the same thing is going to happen. It's going to be worse. Even a 20% decline over the next couple of weeks. I have to tell you, guys, take a chill pill. I know some of these analysts, maybe they're hungover from Turkey Day, whatever it is. We're down 2% from the highs. Relax, we're down 2% from the highs. That's it. And I'm bringing this up because, I'm getting lots of questions. People saying, hey, you worry about the market's heading into next year. I see this starting to come down. It's 2 days. It's 2 days. Of course I'm getting these emails after the market falls, because it's just, you don't realize you're being controlled, but you are. I mean, everything you read, everything you do influences your next step, right? So, you're watching something and you see something, you're going to react to it. when everything is just pounding you and saying, hey, market's going to come down, you just read negative stories, you start getting negative. And they start conditioning you. That's okay. Why are they doing that? Because negative sells. It always sells. You want proof? If you go on social media, when you post something nice, everybody likes it, you don't care. The person that doesn't like it, you're going to respond to, especially if they say, oh, this is crappy, or you don't know what you're talking about. That's the person you respond to. The negative one, not the positive ones. Never. That's just how we're programmed. But the market coming down, look, I'm going to give you the same advice I've been giving you for at least the past 3-4 years. Buy the dips. Stocks are not expensive at 17-time forward earnings, and not dirt cheap, but they're not expensive, and especially not expensive given our super low interest rates. With the Fed, they're not expected to raise rates anytime soon, especially during an election year. And speaking of election year, stocks tend to perform the best. And the most important factor when it comes to politics and getting reelected, I don't care if you're a Democrat or Republican, but if you want to get reelected, the biggest factor is the economy. Everybody knows that. That's not a secret. That's not debatable. That's what people focus on. It's going to be hard to get Trump out of there with stocks at all-time highs, unemployment at all-time lows, or close to it. And yes, you could point to retail factors and manufacturing, and there's some pockets that are showing that we're not really, really strong, but we're not weak. The economy's chugging along. People are spending like crazy. So when you see these factors, unemployment, record low, stock market, the all-time high, Trump knows this. And if we see a significant pullback early in the year, what is he going to do? Because if the market crashes 25% heading into November, he's done. Anyone's done. It has nothing to do with what you did in the past. It's all about what you're doing right now. And maybe over the past couple of months, maybe. But there's no way. So he knows he's got to do everything in his power. And he's been pretty upfront about this to make sure stocks go higher by putting the right policies in place, whether it's deregulation, whether it's tax cuts. I mean, I'm sure he's going to start floating ideas of more tax cuts if the market does come down. He has the ability to really, really play nice with China since we are totally in the driver's seat. I mean, you listen to conference calls, I have to say probably 40 to 50% now. Look at the numbers in Taiwan. I know I just said that and you're never going to look at them. But just if you get a chance, just look at the numbers and the figures in Taiwan and Malaysia. The American companies are moving. If you listen to the conference calls, they're moving their supply chain. They already moved their supply chains, and a large percentage of them out of China. That business isn't going to come back once a trade deal is solved. And then you have Hong Kong. You're looking at the statistics. I mean, I broke them down. China's a disaster right now, other than Singles Day, which, was awesome. But man, it's crazy. So we're in a driver's seat. He could turn on the positive, turn on whatever he wants, betting on where the stock market is in the S&P 500. But we have very favorable Fed policies in place, a very favorable president who's, everyone knows, his gauge on economic growth in the economy is the S&P 500, whether you agree with it or not. I'm just throwing facts at you. And he's going to do everything he can to make sure stocks go higher under his presidency. So when I look at these factors, I just don't see stocks pulling back and continue to pull back with these massive tailwinds. But here's the key difference, guys. It's not just simple where, hey, just buy the pullbacks and you were buying all the technology company. No. It's a different market now. And finding which stocks to buy in those pullbacks, that's where my next guest comes in. His name is Meb Faber. Meb and I go back about 7 years. I met on stage at a Stansberry conference. We spoke. I think we both spoke at that conference. And then I spoke at several conferences with him over the years. And we just hit it off. And it's not because, Meb is a great analyst. It's really, really smart. But he's just cool, down to earth, and a straight shooter. And I always like that. And, we always got along. If you never heard of Meb, I've had him on the podcast a few times. But he's the co-founder and chief investment officer of Cambria Investment. He also is very, very big into ETFs. He's probably one of the smartest guys you'll ever hear talking about that industry because he manages ETFs for Cambria. and also separate accounts, which, we're going to get to in an interview. He also has his own blog and host of his own podcast. I'll give you one guess what the name is: the Meb Faber podcast. And I have to say, it's one of the few, hopefully I'm not insulting too many people here, one of the few financial podcasts I listen to, because he has good guests on. He's entertaining. He's cool. He does it every single week where I don't have to worry about him missing a week, which, we always see in this industry, because I tell you, I may have talked to probably at least 50 people in this industry, in my industry, want to do podcasts. They hate it. They laughed at me. Now they all want to do podcasts. And I tell them the same thing of how to be successful. Nobody ever does it. Just don't miss a week and be yourself. And, make sure you get really good guests on. But always have really good content. Always try to educate your audience. Always try to listen to what they want. But, the biggest thing is being consistent. And Meb's one of those guys that is. Does a podcast every week, has great guests. And again, one of the few I listen to in the industry. But Meb's a quant analyst who has authored numerous white papers, as well as several books. I mean, his research, I said it just before, I love it. It's really detailed. It's amazing. It's always filled with tons of numbers that support his thesis, which, by the way, I mean, if you want to know the best way to spot great analysts, it's finding people who could change your mind about something that you're dead set against by putting facts and figures in there to support their thesis. I mean, there's not too many people that have done that in my career where I'm like, no, this industry is bad. And some person actually showed me research and I read it and completely changed my mind and said, whoa, that's how you really know if there's a good analyst out there. And Meb, in certain cases where, I disagree with him, and after reading his research, I was like, wow, this is pretty impressive. That's how I knew how good of an analyst he was. I know all of you know that. If you follow his work, he is really great. I'm not talking him up here. He's just really cool. You're going to hear from him in a minute. And, of course, he's going to share his favorite ideas with you, including one idea, which he is going to suggest, is the one place every investor should be investing, at least a small portion of their capital, but they should be investing in right now. So really great interview coming up. Then in my educational segment, I'm going to cover a new area of the market that's finally seeing some love after 8 years of underperformance. I'm not talking about mining. I'm not talking about materials. And I'm not talking about uranium. It's going to be really cool because I'm going to show you how to find the best stocks in this space that have the potential to generate more than 50% returns in just a few months. I'm not kidding when I say that. 50% returns in just a few months. And I'm going to give you examples of this happening. This is an area of the market a lot of you know, a lot of you have heard of. Please listen to this educational segment because this sector and this style of investing is going to dominate the markets at least over the next 12 months. And you have a chance to get ahead of it and buy some really amazing stocks. Some of those I'm going to share with you in my educational segment in just a minute. But first, let's get to my interview with the one and only Meb Faber. Meb Faber, thanks so much for joining us again on Wall Street Unplugged.
Frank, great to be here, buddy.
Well, let's get right to the markets here, which sold off a little bit this week, but very close to all-time high still. When it comes to your clients and telling them, giving them advice because, everyone's wondering, what should we do here? Maybe people are nervous. What are you telling them in a market like this that continues to go higher and higher? Is it, hey, buy heading into an election year to take profits? Or is it more, forget about what the actual markets are doing, maybe shift allocations where, we're finally seeing a huge move from growth to value for the first time in many years. There's a lot of smart money starting to pour into value stocks.
As we wind down this year, as we wind down this decade, which I'm not really prepared for, and as in the coming weeks, as New Year's Eve rolls around and you toast your loved ones with a glass of champagne, or for you maybe a Bud Light or some chamomile tea, whatever it may be, when you look back, we're pretty long-term focused, and what an awesome decade this has been, particularly for U.S. stocks. If you look back over the past 11 decades, and it's not over yet. Anything could happen in the next 3 weeks, but it's mostly got a bow on it. It's been a fantastic decade. It's been one of the top 5 decades for the U.S. stock market going back historically. But what does that mean going forward? And just using that statistic, by the way, means that historically, when you have the really good years, and by the way, just for perspective, after inflation, the U.S. stock market's done about 6.6% per year. Add on inflation, that gets you up close to 10, right? This decade is probably up around 12, somewhere around there. The best was the 1950s, which was 17%, and the worst was the one prior to this one, the 2000s, -3. But if you look at the next decades after the best ones, the future returns, this is the 1920s, 50s, 90s, and those have done 15, 16% a year. The next decade was like 1%. And then if you look at the worst ones, 1970s, 1910s, 2000s, they lost about 3% a year. Future returns were great. They did about 12% a year. And so, we're kind of in the middle. We're a little bit in the top half. But, there's always the famous saying, if you say but, everything before you said that, ignore.
Exactly.
The U.S. stock market, we think, is on the expensive side. I don't think it's crazy like the late 90s. So you combine those two things, and the diagnosis is that, hey, look, we've had an awesome run, but take your leave after New Year's Eve, New Year's Day, wake up, sober up a little bit, and have some perspective. The average investor consistently expects 10% returns, plus the average pension fund is around 8. But if you look at the U.S. opportunity set, U.S. bonds, sub 2%, we know that. And then U.S. stocks, we forecast low single-digit returns. Even Vanguard, saying a diversified portfolio of U.S. stocks and bonds, you should expect 4 to 5%. And so a lot of people aren't prepared for that because they extrapolate where we've been. So celebrate this wonderful decade, the first that hasn't had a recession. There's been a lot of firsts this decade, and particularly the U.S. stock market outperformance versus the rest of the world. But again, I'm a trend following guy, and so this can continue on, as we know, for markets. But as far as expectations, at least have a little bit lower expectations for the coming decade.
So, Meb, great stuff there. And by the way, I think it's so funny. I drink Bud Light. I do. I get shit on all the time by people. You drink Bud Light. There's so many good craft beers, but I think it's so funny. That's how many times we've drank together. But you brought in a lot of good statistics there, and I guess the biggest question for me is, where do you spot value? Because you're talking about U.S. stocks, and you're looking at 4 or 5% returns, whatever it is. Maybe it's a little bit higher, but again, you're not going to get 10% on average. And I know that you look at international markets a lot. Are you seeing any areas there where, hey, it's about asset allocation where, yeah, U.S. stocks could do well, but it's not going all in on U.S. stocks? I know you folks on a lot of the geographies, a lot of countries. Are you spotting value there? And I know, the answer is probably yes, but not just value, but are we seeing the trend turn maybe in Europe where, of course, value stocks could sometimes get even more cheaper and cheaper? You want to see some kind of growth component, but what are you seeing outside the U.S.?
Yeah, I'm going to make one more comment, and then we'll cannonball across the pond to the foreign markets. I was looking at expectations for Wall Street analysts for next year for U.S. stocks, and they all clustered between -3% to 10%, which seems to be fairly normal. But what's interesting to investors is they look at their portfolio. That range is actually incredibly rare. So, for example, that only happens about 1 in 5 years, where you're -3 to 10%, where 80% of the time returns are better than 10% or worse than -3. And so over the short term, anything can happen is partially my point. So this year is a great example, U.S. stocks romping and stomping. But for this long-term perspective, if you look at valuation, and most of the listeners in the U.S. will have the vast majority of their portfolio in the U.S. Typically for stocks, it's 80%. When as a percentage of the world, U.S. stocks are really only half as far as the index. And as a percentage of GDP, down around a quarter, and the percentage of population even less. So if you look around the rest of the world, the bad news is U.S. stocks are expensive. The good news is the rest of the world is reasonably priced. So foreign developed is down around a long-term P ratio of 20. Foreign emerging, which is one of my favorite ideas, is down around a P ratio sub 15. And then the cheapest of the cheap, the really gross stuff, is down around a P ratio of 12. And so the funny thing, though, as you take this perspective, and people listening right now are probably pulling their hair out. They're saying, oh, my gosh, why'd Frank invite Meb back again? Everyone knows emerging markets are total dog. Why would you ever invest in that? That's so stupid. You can't trust China, yada, yada, yada. Well, the funny thing is, if you look back from 2000 to the 2000 decade, emerging markets outperformed the U.S. by something like 300 percentage points, not basis points. Over the whole period, U.S. was a bagel, had zero returns essentially, and emerging markets were romping and stomping. So everyone loved them in 2007, the BRICS, et cetera. But they got really expensive, trading in P ratios in the 40s and 60s for many of the countries. And then, of course, what happens, 10 years goes by, and the U.S. stock market stomps the emerging markets. Emerging markets have done terrible this decade, and it's flipped. The script is flipped. So emerging markets have done very poorly versus the U.S., which has done amazing. And then markets have a way of doing that. The major romping party, amazing returns in one region, asset class, sets the stage for, kind of more sober times going forward and vice versa. So as you think about your allocation, listeners, for the next decade, certainly I think a lot of the opportunity and valuations are abroad. And you're seeing, as we're talking about trends and what's going on in the world, you're seeing some of those markets really start to outperform. This year, for example, two of the cheapest markets in the world, of the top 5 performing stock markets, Russia and Greece are both up there. I think Greece is up almost 50. Russia is up 30-something. But the U.S. is in the top 5 too. And so people don't really notice as long as the U.S. is still one of the top in the world. But you're starting to see some. I think Russia has been outperforming the U.S. since like 2014 or 2015. So it's you're starting to see some divergences going on, which I think is a good thing. But obviously, there's still a lot of these countries are really struggling. So at some point, we don't know when. We think it makes a lot of sense to be diversified across all of these countries and geographies.
Yeah, you bring up a good point there too, because you're right. Everyone cares about the U.S. as long as the U.S. is in that list. I didn't know that Greece and Russia were in the top 5 either, so I didn't know that. But because the U.S. stocks are doing great, right? When they do bad, you're always looking for alternatives. But it's kind of funny that you said that. Now, I wanted to go into how to play this, right? Because like you said, most of the investors listening to this, most investors that you talk to in the U.S., I know you travel the world and speak at so many different great conferences. They own U.S. stocks, and you have ways of getting into these markets or buying these markets where you have a whole list of ETFs that you can create at Cambria. Why don't you talk a little bit about those? Because I think when people are looking for international exposure, they want it the easiest way possible, and of course that lends to ETFs and things like that, where they can buy them similar to stocks. Why don't you talk a little bit about that? Because it seems like that's how they can get exposure if they want it.
Yeah, and so the easiest way, the starting point, we always tell people is the global market portfolio: half stocks, half bonds, half U.S., half foreign, and then you can start to tilt away from these big passive market cap weighted indices. Obviously, we love value. That's a classic approach. I think it's even more important in foreign markets. So a lot of people, the things they're scared of in foreign markets, particularly emerging markets, are characteristics that often apply to governments, but corruption, whether these companies are squandering cash. So you want an approach or a filter, in my mind, where you say, okay, we wrote a book on this. It's free on our website. If you go to CambriaInvestments.com or my blog called Global Value, but also Shareholder Yield. And so this concept where you want stocks in, say, emerging markets that are generating cash flows. I know you love cash flows, but also distributing them to shareholders through whether it's dividends or buybacks, but also that are trading cheap. So we use a valuation composite. And the last filter we use is a momentum sort. So you get all these factors that make a lot of sense to me where, hey, not only are they generating revenue, they're returning it to shareholders, so they're not squandering it or just paying all the CEOs an enormous amount of money, but they're also cheap. And the last momentum sort means hopefully they're going up as well. So having a thoughtful approach gets you away from the market cap weighting. And the problem with market cap weighting, regardless of geography, is that you end up often without any tether to fundamentals whatsoever. And a fun thing to look at, Research Affiliates recently put out some research talking about this, where if you invest in the largest stocks in a stock market index, just based by market cap, they have horrible returns over the next decade. So one of the easiest things you can do is just avoid the biggest ones in each country. And the funny thing is, you look around the world, this changes every 10 years, but if you look at the largest 10 stocks in the world, of course, it's dominated by U.S. companies now. But 10 years ago, that list was different. 10 years prior to that, it was different. The 1980s was dominated by Japanese stocks, et cetera, et cetera. And so tilting towards thoughtful things keeps you out of, in my opinion, the really bad behaviors. So people are scared of state-owned enterprises or other ideas. But if you kind of check the boxes, the nudges, the behavioral inputs that say, no, I want to make sure this company is not only cheap, but also behaving well, I think that's a big first step. And then if you're really crazy, like I am, our largest fund actually buys the 10 cheapest stock markets in the world. And it does it in a diversified approach with also a value tilt. But that puts you in a lot of the places probably that you don't want to be otherwise. And we mentioned places like Greece and Russia and Brazil that are probably hard to own individually, but as a basket, I think make a lot of sense. And we did a blog post called the biggest valuation spread in 40 years, where versus the U.S., these really cheap foreign markets are at the biggest discount in many cases they've ever been. But the flip side, when we say 40 years, was actually that the U.S. was the really cheap market 40 years ago, and most of the rest of the world was more expensive, in particular Japan in the 1980s. So the times change. It's not always the same. Sometimes the U.S. is cheaper, but right now I think is a great opportunity as you reflect over the next decade to certainly tilt towards the cheaper stuff, most of which around the world is in across our borders.
Yeah, and it's pretty cool that you said that too, because when you look at ETFs, a lot of them, even with China, they cover like the top 25 stocks in China. A lot of these ETFs are built around the largest components, and I love that what you're doing, where hey, those large stocks don't always, the following year or years after, they usually underperform. Here's, a way to get into some of these small, because it's so hard, right? If someone wanted to buy individual stock that trades in Greece, that's a small cap. It's very, very hard. Not for you or me, but for the average investor, it's not easy. You have to open up special accounts. It's a whole new thing. I don't even think you could do that through an E-Trade. You could do it through internet brokers and stuff like that. But I love the fact how you see the problem, and then here's are the funds that you should focus on. Here's the stocks, and this is how we generate alpha. So it's
and two of the bigger benefits of ETFs too that I think are not appreciated but are important. Certainly as the year winds down, a lot of people are thinking about taxes and tax loss harvesting. ETFs universally are a much better way for most people to manage their taxes of individual securities. And on top of that, we do this, and most of the good guys do it, where if you do short lending on the portfolio, we also return all that revenue to the shareholders. And in some cases, there's many ETFs out there, and I can't claim this because it's inconsistent. It's not always the same, but theoretically, you could have an ETF that charges 0.5% that actually returns 0.2, 0.5, or even more in short lending revenue. And in all ways of comparison, it actually reduces the management fee to zero or actually negative. And you see that in some of the high short lending places, and that's really, really hard for an individual to do. A lot of the short lending through brokerage accounts, it can be risky, but for many of the institutions, it's a pretty big benefit of the fund structure too.
So I want to move on from ETFs because I want to talk to you about something personally that I've really been getting into and trying to study as much as I can. It's a very secretive industry, but you're a quant. You have great contacts in our industry where a lot of hedge fund managers. I wanted to get your take on algo trading, so algorithmic trading, where it controls more than 80% of the market right now, the computer trading on these exchanges. But the volatility that I'm seeing as someone who's covered the markets 25 years, where stocks would come down, they miss a quarter, I'm thinking they should come down 10, 12%, and they'll fall by 25, 30%. And same the vice versa. If you're looking at a stock that beats earnings, aftermarket will be up like 6, 7%. I'll see some of the, especially small mid-cap stocks, they'll go up 25, 30%, where it's just like all this volume coming in at the same time, just bidding up. It's one of the things that scare me in this market because it's something that we don't see coming and we don't know. But I want to get your take on it, where, you look at the Renaissance Technologies, you look at Two Sigma, where a lot of these firms have not had losing years. I mean, they're not looking at fundamentals at all, right? They're just basically going in trading who could do the quickest millions of trades per second. What are your thoughts of this? Is it a risk? Should I be worried? Should anyone be worried? Or is this something, hey, this is a new norm and just get used to it?
I'd like to make a couple comments. The first is you mentioned Renaissance Technologies, and there's a great book out called The Man Who Solved the Markets or something like that about Jim Simons. And it's a really thoughtful, wonderful book. I was actually on speaking with next to the speaker in Toronto recently. And it's a fun book about this quant and famous mathematician, code breaker, university professor. And it's interesting because when you say quant or algo, it means a lot of different things. So on the extreme side is sort of this high frequency trading totally based on machine learning, genetic algorithms, whatever. On the far opposite side, you have something that just means rules based. So you have the S&P 500. That's a quant fund. You have someone who says, I do a 60-40 portfolio rebalance yearly. That's a quant algo strategy, just a very simple one. So everything in between. And so the fun thing about this book is it shows that despite being the best performing hedge fund of all time and it being based on kind of the more high frequency quant stuff, there's still a very real human element. And it goes back to why this is so hard as an investor. I mean, it details a few times over the history of Simons managing these funds where he's like, maybe we should change the systems, or is it time to, protect and short the stock market, or all these things. You're like, you're the most famous person ever that shows you're not supposed to be doing this. Why are you doing this? But like the emotions creep in, and that's what causes us, as we all know, to behave very poorly and causes the fractures in our investment process. And so that having been said, going to your question of kind of how these strategies and funds can impact the markets, I think one of the biggest and last pieces of alpha for the individual investor is actually time frame. And so the ability to have a long-term time horizon, I think, is not something to really be scoffed at, where if you look at an investor who says, you know what, I'm investing for my retirement, I'm investing for my kids to go to college, I'm investing for whatever goal it may be, to buy a house, none of those are the next week, month, quarter, year, right? And so if it is the next year, you should probably put money in CDs and just be done with it. And so most of what goes on under the surface of the ocean, washing around, all these things going back and forth, most of us can hopefully successfully ignore. That having been said, do they cause distortions? Absolutely. But that's always been the case with markets, in my opinion. And that's based not just on particularly one style or what's going on in the world right now of passive or indexes or ETFs, but it's just always comes back to flows. And so absolutely do flows change where that money is going to? Of course, and that's been true for 100 years. So all of a sudden, if the Wall Street Journal published a piece about some railroad in the 1930s and every mom and pop went out, or 1920s probably, and decided to buy that railroad, and monies were flowing into that stock. Of course, it's going to change that, but that really has nothing to do with algos. And today, if everyone's putting their money into, Meb's Cambria fund that, hypothetically, we don't do this, that invests in Brazilian small cap tech companies, and you guys put in $50 billion into that fund, is that going to change the composition of that asset class? Absolutely. Same thing happens with gold. We saw it with, certainly a lot of the flows into crypto in and out over the past couple of years. And so really what you're talking about in many ways is, just money sloshing around. Now, as an investor, what can you do about that? Well, certainly the first thing you do is not try to spend a lot of time putting yourself in a position to fail from these events. So if we remember back to the flash crash a few years ago, I didn't even get to experience the flash crash because I was still sleeping. I'm a West Coast quant, so I don't even think I was awake, so I never even noticed it. But most people shouldn't even be looking at kind of their strategies and allocations that much anyway. And so it's something to be aware of. I think it's something to take advantage of. We've certainly a good example. You probably remember this back in the days from the Street, where there was a very simple arbitrage where you could take advantages of the indexes rebalancing, and the old Russell 2000 index rebalance, to where the dirty secret of index investing is they publish their rules. You can front run those indices, and papers have come out showing that That's a very real cost to index investors, where funds or more active traders front run those. But that's a simple flows thing. If you know which 10 stocks are coming out in and which are coming out, you can actually take advantage of the money flowing, and that's just an algorithm. So I think in the most part, it's nothing to be afraid of. I think it's something to be aware of, in particular, to where you could potentially take advantage of it. But also, if you have a trading strategy that is susceptible to anything going wonky, be mindful of it. And so, but for most of us, with long-term perspective, it's mainly not a non-event and a potential opportunity.
It's funny how you mentioned that you missed a flash crash. I have to tell you an interesting story, because I know you know Tom Dyson. So we actually went to the Players Championship, and that's when the flash crash happened. And so we had to keep our phones in the car. It was probably the first time in a good 7-8 years I didn't have my phone, on me, or I had no access. So basically, we were in there I think we got there, 7 in the morning, and we wound up leaving at like 6 at night. And the time we got out, we had it was Stansberry at the time and Brian Hunt. I mean, we had 50 messages each at least. It was funny. The market crashed. You guys, where are you guys? I got to send alerts out. And then by the end, it's like, oh, everything's okay now. We kind of missed it too, which is great. We didn't even hear about it when we were there. But by the time we got back to the car, it was kind of funny, the flash crash. So it was funny that you said that you missed it, because we kind of missed it as well. But I wanted to end with this, Meb. You have decided to start a podcast. You've been doing it for a while now, and I just really gave you like high praise. I lied. I'm kidding. I'm a big fan of yours. It's one of the podcasts that I do listen to in the financial sector. Talk about what made you start the podcast, and now today, what are the benefits you're seeing? Because it was funny when I was doing this, where so many people were like, why you do a podcast for? It's crazy. And the reason why I was able to start Curzio Research is because of the fan base that I have and how many people have listened to this podcast. And it has built up like contacts and networking and interviewing great people and learning so much. But I wanted to see how it was from your end, because now your podcast is really, you're getting a lot more listeners, getting more successful. The Meb Faber Show, it's really cool. Talk about that. And, is it addicting? Do you like it? Is it something that you never thought, more positives and negatives? I just wanted to hear your opinion on it now you've been doing it for a while.
Well, for two old goats like you and I who've been doing content for a while, the interesting part is, content in its myriad forms has been around forever. So a lot of big multi-hundred billion dollar investment businesses have been built upon the backs of other types of content. Back in the day, it was radio or magazine articles. More recently, we started out with academic papers, and then blog, and then books, also, with writing in other places like the Street. And then, more modern, that may be Twitter and the podcast. So really just, as you know, gives you a megaphone and a soapbox to which to spread your views and around the world, for better or for worse. I mean, the difference is, back when we were writing academic papers, a decade ago, and we've written a dozen, but the very first one you had to send to an academic journal, and then you had to get comments, and then you had to go to a committee, and that thing may not see the light of day for like 3-4 years. And in the ensuing years now, I can do a post, toss it up on Twitter, and get feedback in like 5 minutes from hundreds of thousands of people. Will very quickly tell you how much of an idiot you are or not, and that's actually, I think, been really helpful, and I think that's a positive in the sense that there's a lot of transparency and disinfectant of the internet. It can also be a very dark and terrible place as well. But the podcast is just another extension of that. We did a recent post where we looked at the U.S. stock market as when it hits all-time highs. Market only has two states: all-time highs or in a drawdown, meaning it's down from its all-time high. And most markets spend the vast majority of their time in some form of a drawdown. It's like 2/3 of the time you're in some form of drawdown from all-time highs. And so we used to joke, we said that the phrase is you have to be a really good loser to be a good investor, because you spend most of the time somewhere down from the peak, right? If your account hit $100,000 and this month it's at 90, you anchor to that high point, high watermark. Anyway, but the interesting part was that markets actually have some of their best performance and lowest volatility when they're at all-time highs. And so you can devise strategies that say, hey, I'm going to invest in all-time highs, and otherwise I'm just going to sit in cash and bonds. And it's actually, strangely, a really good investing strategy. Anyway, That seems somewhat counterintuitive. In the old days, it would have taken me 2 years to get feedback on that. Now I threw it up on Twitter, on the blog, did a segment on the podcast, and got an immense amount of feedback all within the course of a week or two. The biggest benefit of the podcast, by far, is the ability to pick up a phone, chat with an old friend like you, or even chat with totally new people. Say, hey, that guy is doing some really interesting work, whether it's in mining or in sovereign bond research or investing in emerging market companies in Africa, whatever it may be. And say, I'd love to talk to him. And 10 years ago, if you just said, hey, you want to spend an hour on the phone together, people, billion-dollar fund manager, the chance to interview people, they say, you're crazy. I don't want to talk to you. Don't waste my time. But now it's a great platform. It's fun. We've had a great time doing it. Probably experiment with some new ideas. I know you do a little more video than we do, which is something we're going to try to put in the works in the next year as well at some point. So I'm going to have to hit you up for some suggestions.
Yeah, well, we're not into video too much with the podcast, doing other videos outside the podcast. But yeah, that seems to be the big thing in the YouTube videos, which is weird, right? People just like see someone talking to the microphone. I love it. I watch it on ESPN all the time. Like, it's a talk show I'm watching, but I it's weird that I would like that, but people just, which is cool. You want to give the people what they want.
We'll have to start a Meb and Frank Pardon the Interruption version.
PTI. Still love that show. So let's end with this, Meb. If anyone wants to find out information, if they want to find your podcast, you have a blog that you write about, you have great stories, how can they do that?
Day job is fund manager at Cambria Funds or Cambria Investments. Most of the content that's free. We mentioned the books. You can find it Meb Faber and Meb Faber on Twitter too.
That was pretty easy. That was pretty simple. Sometimes I give that plug to people and they go on for 25 minutes.
No, I'm an easy person to find. You shoot me an email. Love to hear from Frank's listeners anytime.
All right, Meb. So listen, thanks so much for coming on. I always learn something new when I'm speaking to you. Always get some great ideas, and I know how busy you are, so I really appreciate the time. And hopefully I see you soon. All right, bud?
It's been great. Happy New Year to you and all the listeners.
All right, Happy New Year to you too, buddy. I'll talk to you soon. So great stuff from Meb. Love having him on. You can see how detailed his research is. He always shares ideas. He travels a lot, and I just love reading his stuff, even on his blog, because I'm always learning something new and just sharing research and stuff. He was asking me a lot about the STO industry last time I was on his podcast. It was really fantastic. So just a really good source for me, a really good source for you, and someone I trust in this industry, and someone that I admire, and someone that's very, very good at his job. So hopefully you enjoyed that interview. I say this all the time because sometimes I'll enjoy the interview because I'm really deep into this industry, but maybe that doesn't transform into a good interview for my audience. And I always say this podcast is about you. It's not about me. Let me know what you thought about Meb in that interview. Frank at CurzioResearch.com. Again, it's Frank at CurzioResearch.com now. Let's get to my educational segment. So I've been telling you to buy stocks on pullbacks for around 3 to 4 years, but it's not going to be as easy as it was where you could just say Apple pulled back 10%, 15%. You look at last December, most stocks, the market fell a little bit over 20% from September through December. I think it was one of the first 20% declines in many, many years. And a lot of those stocks rebounded. You could have basically threw a dart at the S&P 500. Most of them you would be up on, right? There's a few of them that crashed, of course, but I would probably say about a good 75% of those stocks would be higher, and a good 20% are much, much, much higher, more than 50% higher. And when I'm telling you to buy the dips now, it's going to be different because I'm not going to tell you to buy technology. Why? I'm not here guessing and saying, hey, I have a feeling, guys. I have a feeling. No, this is by crunching numbers, crunching the data, using my sources. This is what I'm seeing in the market. I'm going to help you guys get ahead of it. We've heard a couple of Wall Street Journal wrote about it, a couple other stories wrote about it, that value's making a big comeback. That's true and false. If you look at value, and I'll tell you why it's true and false, because value depends on how you define it, right? And I'm going to go over that in a second as well. A lot of the growth that's taken place, a lot of growth, S&P 500, it's been in these growth momentum names. Technology has been the best performer by a mile. And a lot of people have just been piling on those momentum names. And on the other side, which maybe you don't see, is they've been shorting and just completely dumping anything that's value related. Anything. So if we look at last week alone. I'm going to share this data with you, which is from Bank of America Merrill Lynch. They're the best because they track all of their clients' data, which is hundreds of billions of dollars in capital from several hundred hedge funds, money managers. And they've been doing this for many, many, many years. It's not biased. It's like, here, this is exactly what we're seeing. These are the inflows and the outflows. These are the sectors. This is what we're seeing. They publish a report every single week. It's something I read every week because it's really cool. It gives me an indication where the smart money is going. And you want to try to get ahead of that because you know the billions in capital coming after you are going to be able to drive these stocks higher. Now, if we exclude buybacks, take them out, just energy and material stocks. Energy and material stock, right? These were two of 2019's, this year's biggest laggards. They saw inflows, just those two sectors. And tech stocks saw the biggest outflows. We're also seeing inflows into financials, which is a deep value sector. Institutions have sold tech stocks for 9 straight weeks. And last week's sales, last week alone, money coming out, the outflows, it's been the largest since May. And you can say, well, it makes sense. Technology is good. How good? Well, the technology sector is up 40% year to date, by far the best performer. Now, when you look at value ETFs, they saw inflows for the 12th consecutive week, while growth ETFs saw outflows for the first time in 7 weeks. Now, when you're looking at this trend and you go back even further, and I went back to around mid-September, ETF inflows have outpaced growth ETFs. So you're seeing more money going to value. So to put in perspective, year to date, and this is prior to last week, or which is last week. So growth ETFs saw 3 times the amount of net inflows compared to value ETFs, right? So that's year to date. But if you look at the last 2 months, that trend is clearly changing. And even go back 3 months. Value ETFs, again, saw inflows for the 12th consecutive week. You're seeing more money go into value. So if you're looking at the smart money, I don't know why they call it the smart money, but everybody calls it that. So I'll call it that because you know what I'm talking about, which is the institutional money, so-called smart money. If you're looking at where the smart money is heading, it's value. And it's starting. It's not done. It's not even close to done. It's in the first inning. And why are you seeing this? Because value stocks they've never been this cheap compared to momentum stocks almost in history. It's insane. I cover this stuff because even the Russell 2000, I mean, it was just some of the stocks in there, no news. No news. I mean, I had to stop on one of our stocks that I love so much. You guys know it if you're a subscriber. That I removed the stop and said, take the stop off of this because, and it fell tremendously. And now that stock has bounced back probably, I want to say 70% from its lows in the last 3-4 weeks. I mean, there's nothing fundamental that changed. These are just massive algorithms, programs, where you're pushing tons of money into momentum and you're just selling everything that's value. And these value stocks have been pushed down tremendously. But if you look at, even from Bank of America Merrill Lynch, their research, it shows that value has never been this cheap versus momentum. But their data goes back to 2001, still 20 years almost. 20 years. Now, the thing is, people believe they know what a value stock is. And it could be defined in so many ways. A stock trading at a discount to its peers, trading at a discount to the markets, a bank with the lowest price to book ratio. I mean, I can go on and on here. I'm going to make it simple for you. You're going to hear this a lot. You're just starting to hear, well, value's making a play. Value's making a play. Forget about the word value. What I want you to look is at the S&P 500 and look at the companies that got smoked. Stocks that are down 25, 30, 50% from their highs, maybe the 18-month, 2-year highs, whatever. And this is after reporting consecutive bad quarters. They lowered guidance. So you don't have to look at value as a stock. Hey, let me find the lowest PE stocks. Okay, you could do that, but it's not necessarily where the low PE stocks, they're trading a low PE because their prices probably come down. But I'm looking more at the stocks that really got smoked that kind of also trade at low PEs. So a good example would be stamps.com. And this is a stock that traded over 250 in the summer in 2018, 250. Then it crashed after reporting weak earnings for several quarters. But the massive drop came in February, right, this year, when the company lost a contract with the post office. So stamps.com cut earnings guidance from, I think it was around $11 a share to $5.50. You never see that big of an earnings cut. And they didn't really let anyone know. They didn't warn. It was just kind of, hey, this is earnings. And the stock went from 200 to around 85. It was a massive drop. But the downturn, if you're looking at algorithms and how they play this, it's trend following, basically, right? So now they're seeing this thing get crushed, and they're still piling on. And when you look what happened into May, I mean, did it deserve to be trading at 80? Yeah, probably. They lost their biggest client. I get it. I see it. It's not worth me looking at it saying, wow, are they going to make up the difference or whatever? But here's what's interesting. The downturn continued into May. So from February to May, the stock fell from 80 to 33. 80 to 33. You know what it is today? It's back at 85. I mean, this is just one example of where you're seeing companies that have gone through trouble, and every company goes through trouble, but the ones that do, they're not just being sold, they're being decimated. They're being destroyed. And that's leading at least a lot of ideas for me in my newsletter. You see me purchasing stocks that are fantastic. I mean, another example is GE. You guys know my history with GE. I won't go over it again, but seeing huge inflows. I went from 7 to 11 over the past 12 months. I'm going to bring up another name, Macy's. I know. You say Macy's, Frank, please don't do it. Please don't do it. Please don't do it. I mean, this stock has been crushed. The industry is terrible. Big box retail, department stores going out of business. I even got stopped at this name in Curzio Venture. I thought it was a great buy at a certain price. Today's trading at 6 times forward earnings. Just hear me out before you dismiss this, okay? It's trading at 6 times forward earnings, 0.7 times book. It's generating $650 million in free cash flow, right? People think, oh, Macy's going to go out of, but they're generating $650 million in free cash flow, and they pay a 10% dividend. And you say, wow, 10% dividend, stock must have got smoked. It did. When you look at the numbers, their dividend amounts to $1.50 a share in earnings. The company's generating over $3 a share in earnings, which it could continue to pay that dividend. Maybe they decide to cut it in half, which would be a smart decision. The stock will probably go down 20, 25%. Maybe get income funds that are invested in Macy's that have to get out there based on how that fund is mandated. But that's going to be a perfect opportunity to buy something like this, because it's getting to the point where, and I hate using this term because whenever I hear it, I want to short the stock, but the sum of parts valuations when it comes to Macy's, it's the people who hate the stock the most think it should be trading 15% higher. I mean, there's sell ratings on this stock with price targets above this. That's how depressed it is. Just using it as an example. But I mean, look at the energy sector. I mean, even the best names in the space are down 30% plus from their highs. Pioneer. Hey, look at Devon Energy. Devon, it was 35. It's 22. Let me tell you, Devon is another stock. It was in our portfolio. We stopped out. We're doing well in both portfolios. I like covering my lose more than I wins. If you don't subscribe to my newsletters. Devon is just an awesome company. I mean, it's selling off the non-core assets, taking that money, paying down their debt. They're operating in one of the high-profile areas where you could drill for oil at the cheapest prices. Yeah, it's just a solid company that's gotten destroyed. It's 35, it's 22. It trades at P is 6. Diamondback was 110 5 months ago. It's below 80. I mean, that's how, I won't curse here, effing much, people hate value stocks. So not only have they gotten crushed, but it's just another level of, whoa, let's get the world out of these things, and they get destroyed. So my advice is start by looking at the biggest underperformers in the S&P 500 this year. You don't want to buy all of them. That's your starting point. And I can tell you probably don't want to buy them maybe right now either, even if you do find a lot of things that are positive, since they're likely to fall a little bit further since, we do have tax loss selling. Almost every sector is trading at all-time highs other than energy, materials, big box retail. So you might see some of these names that are down be sold to offset, a lot of the gains that are made because, again, a lot of stocks trading at 52 highs. But once you have the list, and by the way, you could find it by doing a simple search in Google, see which companies insiders are buying. I mean, that's always a good sign, right? When management steps up to buy shares when the stock is down, that's always a good sign. That makes you look even further. Then look at 13Fs, which are the followings from hedge fund managers, equity money managers, anyone who over 100 million in assets under management. They have to file all of their holdings. They basically disclose every stock they own in their portfolio every quarter. If they're adding to position, if they sold some of the shares in the position, new positions. Find out. See, and I covered this. When it comes to 13Fs and some of the stocks that they're buying. See what value stocks are getting into, especially if you have a value manager, a passive investor. Passive investor means it's not like Bridgewater where they're in and out of situations so much that 13F means absolutely nothing because they're probably out of all the stocks that they're telling you because it's published 2 weeks after the close of their quarter. But when you got, just as extreme Icon or Buffett, those guys, they don't take full positions in stocks right away. They take positions and usually add to them over time. Which, again, that's what you want to do is you don't want to try to catch a falling knife. So if you have insiders buying, that's kind of a good signal where, hey, they think it's a great value at that price. If you're seeing the biggest money managers in the world buying, hey, you know what? You have a floor, especially if you got these value managers coming in because they're going to continue to buy even if it goes lower. And that's what you want to do. You don't want to try to catch a falling knife. Because if you're able to pick the right stocks and follow the system, because there is a massive push into depressed names, and you have to do your homework on these, you could see incredible gains. I mean, you don't really need to see these companies go from totally negative to totally positive. No, absolutely not. I mean, all you want to see is these companies go from less bad to bad, and you're going to see these things pop 30, 40% off their lows immediately. I'm talking about in a few weeks. And then if they can follow up with, hey, now earnings have turned. Now the analysts who are covering the stock is going to turn. And then all of a sudden, this cheap garbage value name turns into a momentum name and it starts going high. Now you're talking about 100% plus gains. And that's when the fun starts. You know why? Because then all the guys on CNBC and the technical guys say, hey, you just broke out. You need to buy this stock. And you always love that when you're up like 200% on the stock and people telling you to buy it. And that'll be your opportunity to sell. So you really want to use this strategy going into next year. You're seeing just massive amount of money flow into value that's coming out of technology. This trend is just starting. It's in early innings. And it's the easiest way to make huge short-term gains in the market. So I want to try to get you guys ahead of the market where everyone's going to be talking about this 6 months from now. But if you're an investor, and especially Curzio Venture Opportunities, we've seen a lot of small cap names surge over the past few months for us where, some of them got hit because the Russell was just totally out of favor. And I don't pitch that newsletter often, but if you did get subscribing or been on the fence, get off the fence and subscribe because I think we're going to have a fantastic year in this portfolio. Hey, with small caps, super depressed names, they're going to make a huge comeback in 2020. I've been doing a lot of work in this sector. We've already nailed a couple of pretty good winners. And I'm pretty excited. And look, I don't pitch that newsletter often. I try to pitch it at a time where you guys can make the most money. I just think Curzio Venture Opportunities and the stocks that I'm seeing, the small caps have gotten destroyed. You're starting to see them turn, and it's going to result in a lot more gains for many of these positions that I have in the portfolio. So I'm pretty excited. I'm very, very excited about it. So I wanted to cover that sector for you. I wanted to do an educational segment. The educational segment is always about trying to get ahead of things, trying to teach you guys. Here's your opportunity. We're in the first inning of this. There's evidence showing Bank of America, with their data inflows and outflows, you're seeing it. You're seeing it now. You've been seeing it over the past few weeks. It's going to continue. There's a lot of great, amazing deals out there, even though the market's trading at all-time highs. Why? Because the highest market cap stocks, which are technology, have been driving it higher and higher. Now you're seeing money come out of these. Apple's still holding up well. Google's okay. Amazon has sold off a little bit. Facebook's getting back up there. But you're seeing money rotate out of these sectors or out of technology momentum names, and they're starting to find these really underpriced, totally mispriced stocks. And you really want to be in them before that smart money comes in, and you're going to see more and more billions of dollars flow into Russell 2000 stocks. You're going to see a lot of small cap stocks that have good trading volume. This is the area that you should be looking at. This is the style of investing that you should be focusing on. It's not momentum. It's not growth. It's, hey, let me find the stocks that have got decimated, stocks now trading at lower PEs, and start analyzing those companies. And believe me, you're going to find a lot of great ideas. And remember, you don't need these companies to turn around in 3 months. You just need them to stop the bleeding. And these stocks are so super depressed, they'll pop 30, 40% off their lows once that happens. Okay, guys, final note here. Man, so happy to say this. Next week, we'll launch in Rich Sutmeyer's 2-Second Trader. It's finally here. Team worked really hard to get this thing launched. I'm super excited because it's going to be the first newsletter that I know in this industry that uses algo systems to make trades. And even better, Rich has agreed to put his system on our site. And what does that mean? It means that you'll be able to put your own stocks, just that symbol, in the box, and it's going to tell you the trading levels around it, where to buy and where to sell. It's a scaled down version. Of course, there's a lot more that goes into the system, which is what you're going to get from Rich, which, weekly trades from him all the time. But really excited. I've been through this system for the past 2 months, learning it and going through it, and it is fantastic. It's something that he's been working on and created for the past 30 years. I mean, just going back and looking at the markets and testing these things and retesting and testing them again in order to determine, future markets, future predictions. And this is Renaissance Technologies. This is Bridgewater. These are the guys that don't have losing quarters and losing years often. That made a fortune for investors. So I'm really excited. We've seen this system. If you haven't seen it, go to Curzio Research for free, curzioresearch.com, and you'll look up chart of the week. And I think there's probably maybe 7, 8, 9, 10 stories that Rich has written for us. And just look at the performance of those stocks. And that was all based on his system. So I wanted that proof, that evidence. I wanted everybody to see it first before we launch this newsletter. I want to see demand. Demand has been overwhelming, getting tons of emails in for people looking forward to this newsletter. Finally, we'll launch it next week. I'm very, very excited. And if you're interested in the newsletter and you're not on our mailing list, please go to curzioresearch.com. We have a box right in the middle of the page. It says subscribe. You're going to get free stuff only. You're going to get our weekly breakdown, which is cool. You're going to get our token tracker, which is cool. We're going to let you know when our podcasts are up on iTunes. But most important is that's where you find the best deals and the biggest discounts for everyone that's following me, my listeners. Because I could tell you that the price of this newsletter, we're going to charge double for anyone that's outside of our list. And I know I will be able to get that price because that's how I'm excited about this newsletter. And it's a one-of-a-kind newsletter. So for anyone that's listening to podcasts, subscribers and stuff like that, of course, you guys get the best deals. And that's going to go on probably for the next 2 weeks into Christmas or just before Christmas. So if you're interested, guys, seriously, go to the website, curzioresearch.com, put your email in that box, and you'll get updates. If you like what you see, you can subscribe. If not, don't worry. But don't just subscribe on your own because you're going to see a price that's twice as much for what we're selling it for than what you can get it through, being a client of ours or a listener or a follower. So, long podcast, lots of ideas, strategies. I want to thank Meb for coming on. So, guys, that's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.